Hit it.
It's November 6, 2020, episode 104. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we have a great pleasure to welcome to the show Mike Green from Logia Funds. We have a terrific, wide-ranging conversation about Mike's career and what he sees as the biggest risk out there. After that, we get to talking charts, where Patrick does his best to explain what the heck's going on with this market.
In This Week in Trading History, we go back to the purchase of the island of Manhattan. This week, for the WTF Clip of the Week, we go and do a blast from the past and end with our segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way. So stick around. We've got a great show. Lena, hop on here. What beer are we drinking this week?
So this week we are drinking Beer Bibliotech Breweries. Don't you look surprised? Happy birthday, trucker. New England IPA.
It's actually from Sweden, and my best friend from way back in high school sent us this beers.
That's so funny. Oh, you know what? It actually tastes really good.
Let me give you the description the brewery gave us.
Okay, go for it.
A spicy aroma of lavender, coconut, and pineapple. Spicy, more than fruity aroma from the Sabro hops. The flavor is also more spicy with some vanilla and pineapple. It has a very soft mouth feel and a low bitterness which lingers in your mouth.
I don't know. The description, it went kind of downhill with soft mouthfeel, and then it just got worse. Okay,
all
side
right,
effects.
Give us your disclaimer, buddy.
Yeah, nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include Dragamageddon, electionitis, and thank God it's almost over syndrome.
That's funny. Now, hey guys, before we get on to our guest interview, I just realized that this being episode 104, this is our 2-year anniversary. And Kev, like two typical guys, we totally forgot. Like Lena, please don't be offended. We didn't get you any flowers or any presents, but yeah.
You guys are both in a doghouse.
I'm just surprised you could do the math and you figured it out that it was.
Yeah, that's not my. Thank God I don't use math for anything I do for a living, right?
Yeah.
All right, let's get on to the interview.
It's our pleasure to welcome to the show Mike Green. Mike, thanks for coming on.
Oh, it's a pleasure to be here, Patrick.
It's actually Kevin. I know we're both Canadian.
Kevin,
we sound alike.
Let's do that again.
No, it's all right. Don't worry about it. You know, I kind of laugh because my father says he has trouble hearing us, telling us apart. So there's no doubt about it. So listen, we were chatting a little bit about one of the things that I've seen you on lots of things, you know, Real Vision, all sorts of great shows. And I know you said that you've talked about your upbringing and how you came to be, but I would love to go over it again with you. So you were telling me you're from Northern California. You grew up on a farm. Is that correct?
Yeah, I grew up on a small farm outside of San Francisco in what used to be Santa Clara Valley and is now called Silicon Valley. I raised chickens, and my father bred Weimaraners, and my mother stayed home and baked bread, and it was a idyllic sort of existence for a child who, you can do the math, was conceived in 1969 in Northern California.
Oh, wow. You're about the exact same age as me. So one of the things that you just mentioned, Weimaraners, like, is that the German gray-haired dog?
That is the German gray-haired hunting dog, yeah.
So you guys bred them, like, was it a hobby, or was it more of a...
It was largely a hobby. It was, one of the classic things that my mother was one of those people who always got very, very enthusiastic about anything that was, kind of interesting. She actually grew up on a much larger farm in Oklahoma. And so for her, the whole idea of raising a child on a farm and having them be exposed to animals, et cetera, was something that was very important to her. My father was into hunting. He liked Weimaraners. And so the next thing we know, we've got somewhere in the neighborhood of 18 dogs at any one point in time living on our farm, which is kind of a cool experience for a young kid. But also meant that it took me a very, very long time to decide that I wanted dogs in my house. So,
you can have just one. You don't need 18. So
I have 2 now, but yes, that's true.
So you're there in Northern California, and you decide that foolishly that you're going to go to the East Coast, right? To when you decide to go to university.
Yep. So went to the East Coast to go to the University of Pennsylvania at the Wharton School undergrad. And I didn't think it was foolish at all. I loved it on the East Coast. The change of pace and energy for my 20s and 30s and 40s, for that matter, on the East Coast was fantastic. I absolutely loved it. And,
so the weather didn't bother you?
No,
that's what I say.
mean,
Foolish. That's what I meant.
Yeah, there was. It's funny. You don't appreciate it until you come back to it, and so. There were a couple of times where I flirted with moving back to California. There was the blizzard in Boston when I was living in Boston, where a tree, broke under the weight of the snow, fell on my car, and did no damage because there was already so much snow on top of my car that, the next trip to San Francisco was definitely one of those where it's like, wait a second, why am I not here? But for the most part, I really enjoyed being on the East Coast. I think that there's an intensity and an energy, particularly when you're involved in finance, that is a real asset to be in, the Northeastern environment. I also think that there's a huge advantage to being in the right time zone. It's challenging in a lot of ways to manage money from the West Coast because you're up so early in the morning and heading to bed so early at night that you often don't get to take advantage of what feels like life. So.
Wow. So one of the things is that I know you as a macro guy, and I assume a lot of people feel the same way, but you actually didn't start your career on the macro side. You were more of a stock picker. Why don't you walk us through coming out of school, what you did, and kind of your path to eventually becoming a macro trader?
I actually always just think of myself as a value investor, right? So I'm always looking for things that are mispriced. And I want to understand why that is. And that can be an individual security. That can be a sector. The way I ended up picking single stocks was actually because I was on a macro or top down basis drawn to small cap value as I entered, as I moved from, I had built and sold a software company and had the opportunity to consider multiple opportunities in terms of how, where to invest, and a move to the buy side. It was somewhat general in terms of my capabilities. Did an analysis of where I thought the greatest opportunities were in kind of late 99. My analysis was that U.S. small cap value was the cheapest it had been in decades, not dissimilar to how people tend to view it today. And so I made the transition thinking that the primary focus should be on undervaluation, and candidly got lucky that, roughly 6 months later, the dot-com cycle broke. If it had been a year and a half, I think there's a very real chance that we wouldn't be talking today. I think it's important for people to understand the good fortune that you can have in terms of getting a call like that or having that opportunity set put in front of you early on in your career.
It was a bold move because you were going into small cap value as legends like Julian Robertson and Tiger were retiring from it.
Yeah, I think that was actually part of the opportunity set. So, my view has always been that areas that attract capital end up getting lower returns in terms of the fundamental opportunity set. Areas that, and this is extended if it goes on for a longer and longer period of time, in areas that have capital withdrawn from them, simultaneously create the opportunity for higher returns. As you looked at small cap value in kind of the 99 time period, it looked, as I described, similar to today, where it had been largely ignored. Money had actively left the small cap value space. You might, for those of us who are roughly our age, you'll remember the debate between the new economy and the old economy. And, one of the more popular stories that I tell is in February of 2000, presenting to our largest clients and explaining the opportunities to buy distressed assets, to buy home builders at well below book value, regional banks at incredibly depressed prices, et cetera, relative to technology, which was trading at this extraordinarily high multiple. And, was called out by one of the members of the board for being the dumbest man alive. And just not getting it, right? That there was a new world that was out there. In many ways, again, I think I got lucky, and I think that that's an important distinction because the way the world worked back then, people divided it into small cap, large cap, value, growth, et cetera. And in general, you would have allocations across kind of the Morningstar style boxes, and people would allocate for kind of 3 years. And in March 2000, and just in what I think happened, it's somewhat unique in terms of the way I analyze it versus the way I think other people analyze it. I think you saw people try to rebalance, and they tried to they tried to reduce their overweight into large cap growth or the technology sectors, recognizing that it was a risk in their portfolio. What they didn't understand was that the next available bid, when they tried to sell, was dramatically lower. The ask simultaneously for small cap value, which had money flowing out of it for several years, was dramatically higher, and it just set the stage for significant outperformance for the next few years.
You were only 30 years old at the time. It was and
remarkable, good looking back then too. Yeah,
It was a remarkable foresight, and the fellow on the board that told you didn't get it, I'm assuming he was your senior, and he was probably 10 or 20 years older.
So he was actually even older than that. But so that's the other funny part of the story, was the guy who told me that was a con man named Alberto Villar, who ran a firm called the Amarindo Technology Fund. That was down 94% from basically a month after he told me that I was the dumbest man alive. Yeah. And he ended up going to jail, actually, for stealing from his clients. And he was very well known for having made sizable donations to the New York Metropolitan Opera that he then was unable to stick to. So, to be called the dumbest man alive by a criminal who ends up in jail and loses 94% of the money that was invested with him, in addition to stealing money from other investors, probably made me feel more confident, not less, although I couldn't know the story at that point.
Right. Okay, so you're there, and are you in Boston at this time, or is this in New York City?
When I was the dumbest man alive, I was in Boston.
You were the dumbest man alive in Boston, and it wasn't just because you were living in Boston. And so for the next decade, you stuck to small cap value. Why don't you walk us through the kind of how your career progressed?
Sure. So I was in small cap value initially with a firm called Moody Aldrich Partners from 99 to 2003. In 2003, after having had fairly good success in terms of investing throughout that time period, I was recruited down to join a firm called Royce and Associates, which was the second largest small cap investor next to Fidelity. I joined Royce in kind of March 2003, almost exactly at the point that things really began to take off and go a little crazy. Over the next 3 years, Royce's assets went from 14 billion to 52 billion, which, in kind of a crazy situation, like there were roughly 15 of us running $52 billion. It was a pretty incredible dynamic. But stayed with Royce until 2006. And then at that point, actually, in March 2006, I gave a presentation at a Lehman Brothers small cap conference in March 2006, describing what I called the bubble in small cap value, and explaining to people that everything that I had seen in 99 had actually completely reversed itself. And at that point in time, people were completely enamored of the idea that you could be a hardcore Ben Graham value investor by buying something that was trading at 6 times EV to EBITDA or 7 times EV to EBITDA, and shorting the equivalent asset at 8.5 times EV to EBITDA. And all those numbers had changed dramatically over the past 7 years, such that in my analysis, small cap value had completely eliminated the excess return opportunity that existed in 99 when I looked at it. It had captured those returns far faster than I had thought. And I was fortunate that a prior relationship with Mitch Julis and Josh Friedman at Canyon Partners, at that point, they came to me and asked me to open the New York office for Canyon Partners, which was a well-known multi-strat hedge fund. They had historically always been based out of Los Angeles. They were looking to expand beyond just the Los Angeles area to take advantage of additional talent and capability outside of that region. And go ahead.
Sorry, I just before we get to there, I would love to just kind of walk back and understand this point, this kind of period from 99 when you started and small cap was cheap to the point in 2006 where you're actually giving almost the exact opposite presentation. During that period, is the research you're doing just like reading research reports, going and talking to companies? Like, how did you find your edge, or was it kind of quantitative based where you would just kind of try to create a portfolio of cheap stocks? I would love to understand kind of the nuances of how you invested during those 6 or 7 years.
So my initial approach to investing when I first started was what I would describe as kind of semi-quantitative. So I was very focused on the idea of how to evaluate companies from a theoretical standpoint in terms of, the appropriate calculation of their cost of capital, superior forecasting techniques, trying to make sure I really understood the individual company, but most importantly, kind of operating under a framework of identifying companies that had what I would describe as effectively a quality bias, even within small cap. That was part of what created the opportunity set for me to join Royce and Associates with Chuck Royce. Chuck had a very distinct philosophy in small cap where I don't think he ever thought of it this way exactly. It's the way I think of it. By focusing on quality within small cap, what you're actually doing is you're identifying options that have longer tenor. Right? So the companies don't need to tap the capital markets for financing. They are largely self-sufficient. That creates lots of opportunities for them to grow. It creates lots of opportunities for them to become larger companies, whether through being acquired or acquiring competitors or growing their business organically. Right. And so that had kind of been my focus. When I joined Royce, interestingly enough, while I had a unique experience that could probably only have been replicated close to it at a place like Fidelity, on any given day, we would have 5 to 10 companies coming through our offices. And so the opportunity to sit down with, anywhere from 5 to 10 management teams, and over the course of a year, easily 1,000 management teams, and hear their story, hear the pitch, understand, how they operated, understanding how they saw themselves in the competitive framework. That was just a super, super intense learning period, right? You learn very quickly to classify businesses into different archetypes, whether they're a niche quality business, whether they are an acquisition vehicle, whether it is a resources or, effectively an underlying play on a commodity, et cetera. All of those, it was just an incredibly intense and compressed learning period. And I was really fortunate to have that exposure. While at Royce, I worked very closely with a gentleman by the name of Whitney George. Whitney now is at Sprott, but Whitney was probably one of the best investors in terms of focusing on the top-down sectoral play within a small cap universe. So effectively using equities to express a view on commodities or real estate or interest rates, et cetera. And so, studying with him and simultaneously having exposure to Chuck Royce, who is probably the single finest, single stock analyst I've ever met, was just, it really was an extraordinary opportunity.
How did you find your picks? Like, let's say what you would have chosen in 2000 versus what you were choosing in 2005 after seeing all these companies. How did your investing kind of choices or acumen develop? What were the surprising things that you changed?
So I would say that a big component of the change was that I moved away from valuation being the catalyst to, as I said, business quality or sector being the focus. And so I became much more focused on the idea of what are the structural features that are driving a broad trend into either a company or to a sector, And one of the things that made sense, I mean, I had encountered this early on in my career when I was working with Bain and Company. In general, you find that about 85% of the return is not explained by the stock; it's explained by the sector. And
Right.
so, if copper is going from 60 cents to $3.50, copper companies are probably going to do pretty well, right? Likewise, oil companies became a very large play over that time period. And it's always interesting how people construct the narratives around that. I was fairly fortunate in figuring out that the real story was China's growth and the fact that China needed to reindustrialize and that they were extraordinarily short of commodities. And I never really got caught up in the peak commodities phase, but I was very aware of the dynamics of what could happen there. That kind of set the stage for when I transitioned to Canyon Partners, becoming more and more macro focused. And at Canyon, they've never had anyone who really focused on commodities. Canyon primarily has been a debt business, focused on distressed credit, et cetera. In every bull market, you tend to run out of opportunities in credit, and so as a multi-strat, you begin to accumulate equities. That was, ultimately what they brought me in was to help them manage the equity business. But I also managed to extract concessions from them that said, I'm not just going to run equities, I'm going to run everything. And, as I spent more and more time having given this kind of speech that I think equities are really, really rich. And most people in 2006 would have thought the exact opposite, right? Because the valuations in 2006 through 2007 looked low relative to what we had seen in the dot-com cycle. It didn't seem possible that you would have a collapse that was ultimately greater in terms of magnitude going into 2007, 2008 than you had in 2000. Than you had in 2000. But what people had largely forgotten was that they were buying lower and lower quality, more cyclical names. The leaders had become relatively low quality financials that were incredibly levered, that were very exposed to the housing cycle, commodity names that were extremely exposed to the underlying. Nobody wanted to have a commodity company that hedged anymore because that would remove your exposure to the underlying commodity. And as a result, you just had a very, very different environment going into 2007, 2008 than you'd had in 2000. And again, I was fortunate in figuring some of that out.
So you come into Canyon and they hire you to do this multi-strategy, but it sounds like you got pretty negative right away in terms of.
I was already pretty, So I was already pretty negative when I walked in. It was part of the reason I did was because as I surveyed the universe in 2006, as I said, I literally gave a presentation called "The Bubble in Small Cap Value," and recognized that the expectations that were built into most of these companies just couldn't actually be achieved.
So how do you construct a portfolio to take advantage of your view of the world and this excessive valuation you see in this small cap value?
Well, that was ultimately the opportunity set to go to Canyon. And so at Canyon, instead of running a long equity portfolio, I increasingly was running a short equity portfolio. Again, I was fortunate in having figured out that the way people were modeling home builders, in particular in the housing market, the underlying assumption that people were using for thinking about home builders at the time was that their gross margins would remain relatively constant. And so even if housing were to decline, that would not be that catastrophic for home builders or related entities. And what they'd forgotten is the dynamic of price, right? And this was true for commodities as well. People tended to model these. It was really surprising. But people tended to model them as having a relatively constant gross margin. And so if copper prices fall from $3.50 back to $1.20, your gross margin doesn't stay constant, right? Your costs have retreated because the price of oil has collapsed or various other things, but nowhere near as much as your actual price has fallen. And so the back to the dynamics of quality, many of these companies had become levered. Many of these companies had invested significantly to expand. And their business models, by and large, relied on extremely high commodity prices. Housing was the same. It relied on extremely high housing prices and an extraordinarily high level of housing starts. And so just in really simple terms, I joined Canyon in part because they allowed me to short, which I really couldn't do at Royce.
So the great financial crisis hits. Was that a surprise to you, or were you expecting it to be that bad?
I don't think anyone can ever say that they were expecting it to be that bad, and also in many ways not that bad, right? If you had told people that the S&P was going to be down 50% and that unemployment was going to hit the highest levels that we had seen, and that interest rates were going to go to zero, and that Lehman Brothers was going to blow up, et cetera, I think people would have anticipated another Great Depression, right? Another 10 years sort of thing. It was surprisingly intense and short in its duration. I will tell people candidly that, like everyone else, I lost money, or like most other people, I lost money at various points in 2008. I ended up doing very well on a relative basis. But you learn something new every experience, right? So to have a month like August of 2008 where I lost $100 million, that was a learning. I think you put that in quotes and call it a learning experience.
I remember as well. It was hard. Like I was short and I bought too early, and if you were too early getting long, you got crushed. And it was shocking how far it went down. And
it was shocking how far it went down. I think because a lot of people treated it that way. People tried to get in ahead. I think a lot of people had lost kind of the imagination that copper could go back to 70 cents sort of thing. Right. I think people had broadly settled into I remember a brilliant analysis one of my peers did in June of 2000, looking at oil prices at $140 and basically saying, look, this is a tax on the consumption basket of the American consumer that cannot be sustained. And it's often, people tend to forget that what really, at least in my analysis, what really started the break in the housing market was Hurricane Katrina, which caused an extraordinary spike in gasoline prices. And basically from that point, you started seeing people abandoning properties in the exurbs that no longer were economic given the dramatic increase in oil prices. Right.
Wow, so I've never heard that. You actually think that was the trigger to the crisis?
Yeah, I think that was the proximate trigger to the breaking down of the housing market. It was not, it's one of the fun. It's both fun and distressing when you actually know the players involved and you really know the story. When you watch a movie like The Big Short, and the focus is all on, when interest rates normalize, these people aren't going to be able to pay their mortgages. And of course, that never happened, right? You never actually hit that mortgage cliff. You never hit the refinancing point. If anything, you had interest rates fall, and it was the credit quality and people walking away from properties, the first payment defaults where it was just outright fraud. Those are the things that actually caused that to collapse. But the economy had begun to weaken quite dramatically in 2005 with the spike in oil prices.
So let's go on here. You are Canyon. You go off on your own. Eventually, you end up at Peter Thiel's company, and I guess you're well known for the VIX Volmageddon. You want to talk a little bit about how that worked out?
Oh, it worked out well.
What did you see there, and how did you come up with this this view that this was going to occur?
So in 2017, so just very quickly, following the global financial crisis, in the next turn of the value investing, because I had been involved in the ABX trade, the Big Short trade at Canyon, I began to take an increasing role in terms of helping Canyon hedge its exposures. And as I began to do that, I actually realized that much of what was being offered to us as hedges offered a higher embedded return than the products that we were buying, right? So you would be incentivized to go out and purchase protection in the form of a CDS contract against an investment grade bond. You would buy the investment grade bond yielding 11%, and then you were supposed to go out and hedge a fraction of that using CDS or various other products. And most people didn't take the time to reverse engineer what the implied return associated with that long CDS or the reverse shorting CDS looked like. And I was fortunate to figure out that selling puts or selling volatility or selling CDS had returns far in excess of the underlying securities, right? Okay. And so I was able to convince Canyon to allow me to use their balance sheet to run a short vol strategy, very similar to what transpired in the 2006 time period, where in 99 I'd gone into small cap value. By 2006, I was looking at it and saying, geez, we should really be, we should really be shorting these things. As we came into the end of 2013, 2014, I began to look at the vol markets and say, you don't want to be short vol. Right. The returns associated with selling vol contracts at these levels do not compensate you for the risk.
Can I just interrupt there? For a little while, it was trading really fat versus like realized vol because everyone remembered the great financial crisis in general, right? Like vol was overpriced for many years because of the fact that the great financial crisis had been so ugly and people had gotten so crushed. And so this was in their mind and they were overpaying for it. Is that a fair generalization?
I think that would be the narrative that most people would use. The way I would describe it is that there were significant regulatory changes that occurred post 2006 that first began the process of driving up the price of that volatility and then set the institutional conditions in place that prevented that volatility from returning to the prices that existed before.
Okay, can you explain that? That's a great, I've never heard anyone say that, so I'd love to kind of dig into that and learn.
Sure. So in 2006, there was an obscure piece of regulatory change tied to the variable annuity space called C3P2. It sounds like a robot, but it actually is what many would think was a very minor change in the regulatory framework, but it required variable annuity providers to actually hedge their portfolios against extreme outcomes. And in 2006, if you had looked at a typical variable annuity contract, it would have said something along the lines of, you invest in this variable annuity, I will pay you 6.25% interest. But if the S&P goes up by a certain amount, then that interest rate begins to rise, right?
Okay, yep.
And the contracts were typically very long dated, so they'd be 10 to 15 years in duration. People would often use them as various forms of retirement income, et cetera. Insurance companies were very active in offering these. And the regulators looked at that and said, hey, wait a second, this creates a funding need for you potentially 10 years off into the future, 15 years off into the future. You need to hedge your exposure to that. And so at the end of 2006, this change occurred. The insurance industry said, how can we possibly do this? Of course, they go to the bright backroom boys at places like Goldman Sachs and elsewhere and say, we need to figure out how to buy deep out of the money 10 to 15 year puts against equity performance.
Okay.
And that was actually the genesis of the Warren Buffett trades in 2007, where he sold puts on the S&P, the Nikkei, the FTSE, et cetera, with 15-year duration. And that was initially a trade that he presented as it was super cheap financing, because by selling those puts, he was receiving cash up front that he could invest.
Right.
By November of 2008, that looked like a complete disaster, right? He had sold these puts. The cost of the puts had exploded. There were concerns about his solvency. But what people hadn't really paid attention to was the fact that he had structured the trade so that he never had to post collateral. It was a brilliant trade on his part. Where it was less brilliant was in the Goldman Sachs, Morgan Stanley's, Bank of America, Merrill Lynch, what was then Merrill Lynch, who were on the other side of the trade. They had sourced this risk from Warren Buffett, and then because their risk controls required them to sell off a fraction of it, they had done so, but not extracted the same concessions in terms of not having to post collateral. So if you imagine what occurred,
yeah,
the Goldmans and Morgans, et cetera, of the world were suddenly having to post collateral and not receiving any collateral back from Warren Buffett. That meant that they had a huge hole in their balance sheet. And so in late 2008, they were forced to go hat in hand to Warren Buffett and say, hey, will you restructure these contracts and lend us the money so that we actually have the cash to do this? And, Warren scribbled on the back of his envelope, as he often talks about, and said, sure, I'll do it. I'm never going to do it again. You understand, I'm not going to post collateral. I won't enter this contract again. But yeah, I'll tell you what, why don't we do this? You give me $10 billion worth of convertible preferred paying 10% interest, right?
Right.
And so it was a fantastic trade for him, but it created conditions under which the regulatory framework had not gone away. The variable annuity providers still needed to purchase this insurance, and the providers were gone. And then it was exacerbated by Dodd-Frank, which effectively prevented the banks themselves from taking directional risk in that type of exposure. And so from give or take the end of 2008 through June 2012, there was extraordinary demand for these types of hedges, these long-dated put contracts, and nobody who could really supply them.
Right.
And so prices did exactly what you would expect under those conditions. They exploded. And as late as June 2012, if you had looked at the implied probabilities associated with a 10-year put contract on the S&P, it would have suggested that there was roughly a 50-50 chance of the S&P falling by 50% over the next 2 years. It wasn't a real forecast. It was just where the pricing cleared, given the institutional restrictions.
Right. And then some kind of the pension plans and some other people realized that they could augment their already low return strategies by selling that vol, right?
That actually happened a little bit later. So there were a couple of changes that occurred. So one, in June 2012, the CBOE began to list 10-year option contracts, which allowed you to put this onto an exchange.
Okay.
Which changed the character of the market from OTC to exchange listed, expanded the pool of potential providers of those vehicles. The second thing that happened was over the intervening period from give or take 2009 through 2012, the variable annuity providers themselves had begun to restructure their policies and retire some of the older policies, so the demand fell.
Okay.
And it really kind of hit a crescendo in that June 2012 time period where there was suddenly a significant increase in supply and a significant decrease in demand. And of course, that caused prices to begin to fall. In my analysis, that is actually what kicked off the rally that began in the, kind of August, September 2012 time period. In just really simple terms, it became cheaper for people to purchase insurance. And if it's cheaper for people to purchase insurance, they can buy more. So it was not tied to my analysis is it was not tied to Draghi's, whatever it takes, et cetera.
And so walk us to the point where you're eventually saying, look, this vol is super cheap and that there's a problem here because there's too many people short. How do we get to that stage?
Well, so in all candor, I got there early. Probably should have stayed short volatility through 2017. But the simple reality was that it actually got cheaper than it ever had before because retail did what it is often known for, and actually the institutional space as well. The demand for protection and black swan type insurance that dominated from 2009 to 2012. And I was kind of known on Wall Street as the crazy guy who would go to an idea dinner and people would say, what's your best idea? And it would be, sell puts, buy calls. And the institutional response at that time was, we don't sell puts. Right. Nobody was allowed to sell puts. Again, I was extremely fortunate that Mitch and Josh at Canyon allowed me to do a lot of that. By 2016, 2017, that had actually completely flipped, and the most popular strategies were selling puts, right? It was yield enhancement strategies designed to replicate or enhance the return associated with investment grade bonds or equity ownership, and products that had initially been created on the retail side for people to hedge their exposures things like the VXX, et cetera, or, UVXY was a related product. Those had been completely flipped on their head, and people were speculating on the inverse of those products, effectively the inverse VIX products, thinking that these things just printed money. I mean, very famously in 2017, there was a Wall Street Journal report talking about a target manager who had made $4 million, going long XIV, that he had raised a $100 million fund to be short volatility. That this was just, the trade of a lifetime sort of thing.
Right.
And it was one of those interesting things. I'm good friends with Chris Cole. He and I had been talking about this. It became clear to me that what was actually happening in XIV was that there was a professional trade and there was a retail trade. The retail trade was just to be long XIV. The professional trade was to be short XIV and short its companion product VXX. And by doing so, they were actually capturing a much higher Sharpe ratio trade that I dubbed the money tree. And it basically just took advantage of what's called volatility drag. And so if you have two identical products that behave inversely to each other, if they have high volatility and you are short them both, you capture the volatility drag. Just as a simple illustration, imagine two products that are the inverse of each other, that move by 10% each day, right? So on day one product goes up 10% to, you put in $1, you now have $1.10 there. The other product goes down to 90 cents, right? You rebalance, and on the next day they flip. And so the one at 110 goes to 99 cents. The one at 90 is now up 10%. And so it goes to 99 cents. Guess what? You just made on your $2 total invested, you've now made 2 cents or a 1% return with no significant risk.
Right.
Right. That volatility drag became an extremely popular product. And it's why products like the triple levered S&P or the triple levered Russells, et cetera, that's why those things exist. They don't exist so that retail can speculate. They exist so that professionals can harvest volatility.
Okay.
What kills that trade, and this is what I think I uniquely figured out about XIV, is if one of the legs stops trading because of an event. And so the unique feature associated with XIV was that it had a force majeure clause that Credit Suisse had put in place, such that if it fell 85% on any given day, they had the opportunity that they were highly likely to exercise to shut the fund.
Right.
And so what that would leave is the two sides exposed, right? I was also very fortunate in figuring out that there was a lookalike product in the form of SVXY that had options against it. And the options on SVXY, this is where the trade really took form. The options against SVXY were priced as if they were a Black-Scholes type option. And what that means is that the center of the distribution, kind of the normal curve, the normal distribution, the log normal distribution that you've heard Nassim Taleb criticize, the center of that distribution is effectively today's price or a slightly different forward price. And so the higher something goes in price under a Black-Scholes model, the lower the probability of it going to zero. But because this was an inverse product, meaning that it behaved in the opposite direction of the VIX, the higher XIV was going or SVXY was going, the lower the VIX was going, the less point change that was required to create the doubling that would cause the product to go to zero. And so the correct distribution for that option was that it actually had an increasing probability of going to zero the higher it went in price. It was a bimodal distribution, meaning that it had this small log normal component associated with normal behavior, but the prospects or the risks of the product going to zero rose the higher and higher it went.
Interesting.
And so I think we were kind of unique in figuring out that there was roughly a 95% probability that the product was going to go to zero over the next 2 years. We purchased a sizable quantity of long-dated puts against SVXY, and I was fortunate on two fronts. One, I shared with my counterparties, who were all people I knew at that point, that they should not hold this risk, even though I seemed to be a sucker, and that it seemed like free risk. So I was lucky on three fronts, actually. One was that I had a capital provider in the form of Peter who was willing to take that risk and do something that sounded completely crazy. The second was that I was clear in communicating to my counterparties that they should not hold this risk. And the thing that I got wrong was that I had 2-year puts and the product went to zero after we put on the trade, roughly 7 months into the trade. So I could have had much more leverage if I just bought 1 year or 9-month puts, et cetera. But I'll take it. And then the last thing that was just candidly luck, I mean, maybe luck, maybe not, was that I got into Chris Cole and I presented in Las Vegas and shared our concerns about these products. And the founder of XIV happened to be in the audience and got into an argument with us. And so for some reason, somebody was recording it, and I got recorded telling him his product would go to zero on a 4% decline in the S&P, while he thought it would survive a 1987 style crash, and it ended up going to zero on a 3.9% decline in the S&P. So I was very, very lucky that my math ended up being right in that situation.
That's hilarious. Now, are these products, are the option curves now correctly priced, or are there still anomalies? And do you think that they still reflect too much of a normal distribution?
I don't think the same opportunity exists. So first, SVXY delevered. Instead of being a 1-for-1 match versus the VIX, it now is a 0.5 to 1. That radically lowers the risk that it goes to zero and effectively changed that distribution quite significantly.
Right.
They also, one of the wonderful things about that sort of event is that Wall Street learns how to price something next, right? So yeah. You are unlikely to see the same mistake made. You're not going to find RMBS pricing the same levels of correlation or the same concentration in the market as you saw going into the global financial crisis, very simply because people understand the error that was made and right. They correct it. I don't think the same opportunity exists, in the same form for those products. And actually, we occasionally use those products as ways. There are still options available on them. We occasionally use them as ways to express a limited risk short vol exposure in our portfolios at Logica.
Right. Okay, so let's talk about the opportunities that exist today. And one of the things that that you've been harping on is the role of passive and how it's affecting the market. So let's talk about, first of all, we just went through the election. A lot of people are surprised that the market has rallied so hard, but I don't think you're as surprised. Why don't you walk me through what you think is occurring?
So I think the irony is, I would say that there's a couple of different things. One is, my analysis of passive is that it creates a market inelasticity due to the behavior of market participants. So people have heard me say this, but passive in its simplest form can be thought of under the rubric of very, very simple rules for how you buy and sell stocks. Literally, passive portfolios are not passive. They are active players with the very simple algorithm. If you give me cash, then buy. If you ask for cash, then sell, right? If you don't ask for cash or you don't demand anything, you don't give them cash, et cetera, they don't do anything, right? And so that lack of responsiveness, that lack of discretion creates rigidity in the market in both directions. What would in economics terms be described as an inelastic phenomenon, right? The second thing that I think happened as people became increasingly aware or concerned that Joe Biden could be elected under a blue wave, I think you saw a very rational de-risking, particularly of the large cap growth names that have done so extraordinarily well over the last several years. And so you would see people accepting the fact that they would rather take the capital gains in 2020 at a 15 or 20% capital gains rate than run the risk that they would be in those stocks and have to take those capital gains at a 39.4 or 39.6 rate under a Biden administration. And so we saw a substantial increase in what's described as stock replacement strategies, where you sell the stock and you buy a call.
Okay.
I would guess, I can't speak definitively to this because that level of granularity is certainly not available to me. There may be others who could figure this out even better. But if you do that in reverse order, so you effectively say, okay, I'm going to buy a call, and once I'm positioned, I've got my call, then I can sell my stock. You entered into a second component that was tied back to what occurred in March. And so in March, there was just terrible performance from people who had sold volatility in the form of what are called call overwriting strategies. This is one of the primary focuses that we had at Logica, was understanding that these options were being sold at the wrong prices. And the terrible performance for strategies like buy right or put right, call overwriting, et cetera, had led to a distinct reduction in the quantity of single stock volatility or single stock call options that were being sold by owners of the stock. That meant that dealers in the market had to create synthetic call exposures when people showed up to buy calls. And that means that you're effectively delta hedging by going, instead of matching a buyer and a seller, you have to synthetically create it by delta hedging and buying the underlying security in proportion to the delta of the stock or the delta of the option.
Right.
If you do that in an illiquid market, you can influence the shares as you try to buy the delta, causing the share price to rise, which now means you need to buy more delta. And therefore you cause the price to go up even more.
Okay.
I think that's what happened in August, where we saw this big run up in those names. Was effectively the dealers were left scrambling on this. You can pull down a piece that we wrote on our website at logicafunds.com called Let's Talk About Skew that highlighted this call skew dynamic that emerged over that time period. But what it was also telling you underneath was that people had taken a tremendous amount of risk off in the NASDAQ, effectively the top names in the NASDAQ. And so as it became clear that there wasn't going to be a blue sweep, people found themselves suddenly in a position to buy back a lot of that risk in particular. It also caused, I would argue, largely an unwind of a lot of the narrative that a blue sweep would lead to, significant fiscal expansion and dramatic increase in inflation that could, under some models, not that I agree with, by the way, but they could have caused a rotation to things like small value, et cetera. And so I think a lot of the behavior that you've seen over the past couple of days has by and large reflected a reversal of that dynamic.
Right. So, Mike, this is Patrick here. I wanted to just talk to you about where we are with volatility in general. I mean, we, even after the Volmageddon event in 2018, each time volatility narrowed down using, let's say, the VIX as our topic, it always gravitated back into the low teens. Then we had this coronavirus that basically spiked volatility up in a huge way. And even though the S&P went into bull market mode and we're making all-time new highs into the summer, volatility stayed north of the 20 handle in the sustained period. And one could argue it was because of the upcoming elections and other things. But now that's behind us. Where do you think volatility is going from here? Are we going back under 20 and heading back into the teens, into a much more traditional lower volatility range, or do you think this higher level is going to be here longer?
So I broadly think this higher level is going to be here for a longer period of time. And the reason that I would actually say that is because we have a different type of volatility this time around. First, there are fewer sellers of volatility than there had been. And even after this is a little bit of a segue, but if you actually if you think about what actually might have caused Volmageddon, I would argue that what actually caused Volmageddon was, again, an obscure regulatory change on February 2nd, 2018, where the Fed modified what are called the CCAR, the capital adequacy ratios associated with short vol trades. So going into that event, there had been an arbitrage where volatility positions were treated less harshly than equity positions. So you could be short vol and have a less harsh stress test than if you were long equities. That changed on February 2nd of 2018. We, somewhat unexpectedly, we immediately began to see a bid for the out of the money puts that would suggest people were trying to cover that exposure. And in my analysis, that is what caused the Volmageddon. So a lot of people like to blame the Fed for nefarious cabal-like activities and trying to prop up prices. I tend to find that the Fed does a better job of blowing markets up unintentionally. And so that's what I think actually happened in February, right? But when that was gone, similar to the dynamics that we're talking about, you'll notice that vol never really made it back to those levels, right? The second thing that happens is that you have to distinguish between index vol and single stock vol. And so index vol is composed of the volatility of the individual securities, the volatility on the individual securities, with a correlation adjustment. And that correlation adjustment is effectively saying, how much do we expect these things to move together? What we saw in the elevated levels of volatility in 2018 was largely increased correlation expectations. And the huge spike that we saw in March of 2020 was very much tied to correlation dynamics. But the thing that has actually persisted has been the single stock vol. So, if I go back to when Apple was making its high in August of 2020, the implied volatility on Apple hit like 50, right? That's an extraordinarily high level of volatility for the largest stock in the world to be trading with, right? It effectively goes back to the observation I made on the 2012 framework. It becomes really, really hard to hedge your position, particularly to the downside. It makes it very hard to hold a profitable, synthetic short position by buying a put. We have not seen single stock vol retreat until the election. And so once the election came through, this is part of the reason why I think my analysis is largely correct. What we actually saw was a collapse in single stock vol. So Apple vol has fallen sharply. Microsoft vol has fallen sharply, much more sharply relative to the index than we've seen earlier in this year. The other side of the equation, though, is correlation. And what we have seen throughout 2020 is a much higher level of correlation. And this fits with my models of passive. And so, as in one form is validation, it's also frustrating because I'm not seeing that correlation priced as cheaply as it had been. It feels more correctly priced, although I still think it is low. I don't think that it is screamingly cheap, as I might have said it was in January, February. And so it's a very long-winded way of saying my expectation is that volatility will retreat, but that it is going to be extremely hard to get back to the kind of 12 VIX sort of level that we have seen historically. I think it's just really, really hard to get back down to those levels.
Now, I want to circle back. You were talking about your good friend there, Chris Cole, and when he's been on a number of our shows, he basically
by the way, Patrick cheats on me on another show.
Yes, we won't mention it. But anyway, so he talked about that dragon portfolio, but really the idea is that there, within your portfolio composition, you go long volatility. And obviously, a number of funds are out there providing a long vol fund, but there's a lot of retail investors that love this idea and hear this interview and they say, how do I put on the trade? How do I go long volatility as a component of building a portfolio? And obviously, you've expressed the idea that there are a lot of complexities for retail investors to put this on. What would you say to retail investors that are looking at adding volatility and can't do it as an accredited investor into a fund?
I don't want to be flippant about it, but I mean, it is extraordinarily hard to do, right? And being long vol is like being short equities. It is a specialist game. It is very, very hard to do. You are paying an extraordinary cost associated with that. You can effectively reverse engineer a level of the VIX into like a cost of capital. And, once you're above 20 or so on the VIX, like your cost of capital is approaching 7-8% in an environment of zero interest rates. That's really, really hard. You need to add an awful lot of alpha to offset those costs. The other thing that I would just encourage people to always keep in mind is the people that tend to want to be long volatility often are running their portfolios in a much more conservative manner already. And so you run the risk of effectively incurring the burden of trying to protect a portfolio that is already less risky than the overall market portfolio. And so I would actually encourage people broadly to just be very cognizant of that risk that you are. And I tend to see this very specifically with people looking for lower quality stocks so that they can get cheaper stocks because they want to be protected in their portfolio, viewing expensive stocks as the risk, and they tend to underappreciate how far they've dropped down in the quality of the holdings that they have.
If you want to be,
so this is one of my.
If you want to be long vol, you probably shouldn't be, because you're already too conservative.
Exactly.
Yeah, that's a great point.
I mean, like that is probably one of the single biggest takeaways that I would offer to people.
That is a great point. I've never thought about it that way. It's Kevin here. Listen, I can't let you go without picking your brain. You managed to time the bull market in small cap value in 99. You managed to get out at the right time. Are you hopeful that we're close to another bottom in the small cap value? And if so, what do you think might be the trigger?
I'm not hopeful, actually.
Okay.
So it is a very clear risk, and we are even more extended on a relative basis in small cap value relative to, for example, large cap growth than we were in 2000. Potentially with the disadvantage now of being, 20 years older, with much more experience and probably much less plasticity to my brain. I would suggest that I misunderstood actually what was happening in 2000 and candidly got lucky. And you hear me use that phrase a lot. Like I can't overemphasize how important luck is. And many people in our industry become fantastically wealthy for the wrong reasons, right? You get a trade, the Big Short, I think, is a good illustration of this, right? I mean, the story of the trade is when interest rates go up, people won't be able to pay their mortgages, and that never happened, right? Actually, the opposite happened. Interest rates fell to record lows, and now you look at home prices, and they're way above what were supposed to be the crazy levels of 2007. And so the entire thesis was actually wrong, unless what you actually understood you were doing was shorting a structured product that was improperly constructed in the form of RMBS, where you'll hear me use the word obscure an awful lot. There was a fantastic article that was written about this a couple of years ago that was called, the formula that almost destroyed Wall Street. That talks about what's called the Gaussian distribution copula, which was the mathematical shorthand for calculating the correlation of mortgages within an RMBS structure. The core of what happened in the housing market was a blow up associated with correlations being assumed to be 30%, and they ended up being 95%.
Right.
That was the story. It wasn't interest rates. It wasn't that home prices were too high. It was that there was a miscalculation in a structured product, right? I think there are an incredible number of opportunities like that are out there. But the single biggest one is a misunderstanding of the dynamics of what passive investment vehicles do and how they influence markets. And unfortunately, the regulatory frameworks reinforce the flow of money into passive. And the narrative of how our business works is reinforcing the flow of money into passive. The dominant feature of passive is to reinforce momentum and size. And as a result, until that breaks, and there are ways it can break, but until that breaks, I think it's very hard to remove that exogenous force.
Do you think it breaks? Sorry, do you think it breaks? I didn't mean to interrupt, but do you think it breaks like a Volmageddon in that it happens almost overnight, based upon some obscure change that the Fed might do? Like, could it be something like that?
That's my bias, and so it's part of. I mean, within our portfolios at Logica, like I have to be extremely humble. And again, you've heard me refer to the number. You say I correctly timed this, I correctly timed that. Like in a lot of ways, you just get lucky, right? I have the humility to know that I don't know exactly when this is going to break, and as a result, our portfolios have to carry the cost of protecting us against downside as well as allowing us to participate to the upside. And that's a very intentional choice because I don't know where that fragility is going to manifest itself. You perversely, under the models that I would suggest for how the market works, you end up with a market that actually can continue to accelerate upwards. And we saw this in the aftermath of coronavirus. We wrote about it before it began in March 2020. We actually predicted that this would happen. And the reason why is because the market's behaving increasingly like a Bitcoin type phenomenon. Effectively, the passive vehicles become hodlers. They are not there to sell to you when you want to buy, nor are they there to buy from you any more than they were originally planning to if you decide to sell. And so what we think happened in March was that discretionary active managers suddenly realized that they needed to sell because they were afraid of coronavirus and the economic implications of lockdowns. And there was no incremental instruction to the passive vehicles to buy more shares, right? They're unimpressed by declining prices. That doesn't give them the indication that something is cheaper. That information can only come from a discretionary manager. And so I'm kind of trapped in this situation where, in all candor, I think that the system will break exactly like that. It will break like a March 2000. It will break like a March 2020. And in the meantime, it's probably going to melt up.
So one of the ideas, though, is that as an institutional investor, you can't afford to have the market melting up without you being invested. But if you're a retail investor and you're willing to have periods of underperformance, why wouldn't you just go and create a kind of a portfolio of value stocks and treat it almost like a private equity and say, this might underperform for 5 years, but I feel like 10 years from now, I will do better than owning the FANG or a market cap based index?
So for a couple of different reasons. One is there is an element of reflexivity associated with stock prices. So if you happen to own a company that is not participating, they have to pay cash to their employees, whereas their competitors that are participating in this sort of bubble market can compensate their employees in the form of stock options and have an actual lower cost than you do.
Okay.
Right. It can create conditions that create negative outcomes for otherwise very strong businesses. We saw this in the commercial real estate where nonsense companies like WeWork, were able to meaningfully impact the ability to lease office space. Now, of course, it created various types of bubbles, but just stop and think about how crazy that got relative to where we are today, where there's very real conversations that people are never going to go back to work in commercial offices, right? I don't actually agree with that, but that, we've come a long way, baby, I think is the Virginia Slims line on that. the second thing that I think you have to be really careful with, and I had a really good conversation on Real Vision with a guy by the name of Dan McMurtry about this, who's a brilliant young investor, who's kind of taken to heart some of my flow stuff. The other thing that it creates is that bubble creates the sort of phenomenon that led to me being called the dumbest man alive in February of 2000. Because if you're a value manager on the institutional front and you're not participating in this sort of market rally, you're going to get fired and you're going to have to sell the shares that you and other thoughtful value investors have carefully accumulated. And that weakness in the holder base creates conditions for even further underperformance, which means there's going to be even more selling. Right. And I think that is the dynamic that is in play right now.
So the pain continues. Morale will,
the beatings will continue until morale improves.
You got it. You're better with the lines than me. Listen, Mike, before I let you go, I know a lot of people, you've been in the industry for a long time. If you were talking and counseling a young person today that was interested in getting into finance, what advice would you give them?
So part of it is a distinct element of sobriety. So remember that what causes growth in this industry is the growth of financial assets. Whether we want to charge 3 basis points or 150 basis points, people get paid for managing assets and generating returns. And one of the real challenges that we have is that this industry has a bit of a death valley ahead of it, with the baby boomers aging out and retiring and consuming their assets as compared to contributing them. So if I look at the underlying flow characteristics, many endowments, many individuals are moving into a harvest mode, which means that the industry gets tougher, not easier. And so that's just as a bit of sobriety. Horace Greeley is famous for saying, "Go west, young man," because that's where the growth is. And, the same thing, I'm blanking on what his name was, but why do you rob banks? That's where the money is. There's
Willie
less
Sutton.
And less money in this business. Willie Sutton, thank you.
Yeah.
So you helped me out. There we go. But, there's less and less money in this business.
Right.
And so as a young person, just be really thoughtful about that. The second thing that I would encourage people to do if you're young is, one, develop programming skills, because I think that they're going to be really critical, not necessarily in the quantitative space, but actually I would really, really encourage people to look deeply at the dynamics associated with decentralized finance. And in particular, I've made a lot of noise on the importance of understanding smart contracts in the form of things that are built on the Ethereum type networks. Because part of what's happening with the growth of passive is that the industry is effectively experiencing a massive loss of diversity. And explicitly what that means is every stock begins to behave like every other stock. And if there's something about your stock that means it can't be included in a Vanguard or a BlackRock index, your stock, your credit, any bond you issue, if there's something about it that prevents it from being included, you're going to face a much higher cost of capital. And as a result, you're going to see a decline in diversity amongst financial instruments. And that's death for financial industry. I do think that things like smart contracts on the Ethereum type platform will set the stage for a resurgence. I don't know when that's going to happen, because I think you have to kill the passive vehicles first. But they may kill themselves because of that loss of diversity, and there may be other opportunities that emerge. So if I were 25, if I was advising somebody who was 25, I would actually encourage them to focus on tokenization, crypto assets, and really deeply understanding, what it means to talk about capital structure and security creation, et cetera, things that we've, by and large, I would argue, lost.
That's great. So listen, that's some great info. And before I leave you, I'm just dying to know you. You say you have 2 dogs. Are they Weimaraners? What breed did you go for?
No. They're rescues.
Good for you. What did you rescue?
I moved beyond breeding an awful long time ago. I don't have the tolerance for farming or raising animals.
Yeah.
But they're terribly behaved, but I love them very much. So
I always say I had 2 dogs at one point, and I always said it's a lot more romantic sounding than it is in real life. But anyways, listen, Mike, thank you so much for joining us today. Why don't you tell people where they can find more about your firm and yourself?
Easiest way to find out stuff about Logica is www.logicafunds.com. I also encourage, we regularly write white papers that are available on the research section of our website. Those will talk about anything from value investing to I have a much delayed piece on gold and Bitcoin that I'm actually coming out with. And then the other thing you can do is follow Wayne and I on Twitter. My Twitter handle, confusingly, is ProfPlum99, and I look like Vicini from The Princess Bride, so nothing like myself. And then far more traditional is my partner, Wayne Himmelstein, who is going to give you far less in the way of recipes and far more in the way of philosophy of investing on his Twitter account. But you can find him at Wayne Himmelstein.
And I must say, I stumbled upon Wayne a year back, and it's it's probably one of the most underrated Twitter accounts out there. So make sure you guys follow it. Thanks a lot, Mike. It's been a pleasure having you on.
Thanks a lot, Mike.
Thank you, Kevin and Patrick. I really enjoyed it.
Take care. Patrick, time for talking charts. It was a pretty wild week. I'm interested to see what you were going to say.
Well, you know what? The market. Let's just jump right to the S&P 500. I mean, what a rally, right? Like the reflexive rally that came in the post-election, volatility completely contracted. I mean, we were talking about just the impact. Just from dealers alone, as volatility, when we look at what happened with the VIX, it's the Vanna effect. As volatility contracted, so did the amount of delta hedges that these dealers had to have on the books, and essentially it created at least a reactionary impulse to buy. Where do I have it? Here we go. The VIX is right here. I mean, we're down to 25 on the VIX. I mean, we went from 37 to 25 in 3 sessions. It's just an amazing drop.
Yeah.
What do you have to say about it? Nothing?
I don't have that much to say about it. I think that people were too they thought the world was going to end, and I've consistently have said that I don't think it's going to be as bad as everyone thinks. I think that's going to be a fine, peaceful transition of power if it happens to be the Biden wins. And I've been pretty,
I don't think that this market reaction was much more technical in its nature in terms of the market dynamics than it was about peaceful transition stuff. I still think that's a lot of stuff that can happen in the coming weeks, but certainly the market started off strong. But what was interesting is that almost immediately with the House split, the bonds took a heavy hit. So like the 10-year Treasury yield basically got hammered down to the downside, bouncing already a little bit. But I mean, we went from an intraday high up in the 93 basis points all the way down to 72, like a 20 basis point top to bottom swing within 24 hours. Just huge volatility, and that drove a lot of money back to those momentum names, right? And that's particularly interesting was how strong the Nasdaq came out of the gate, and a lot of those tech companies on there. Let me just snag the Nasdaq here, and particularly what's interesting, it wasn't just the Nasdaq that had this huge rip, but sectors like the semiconductors, like the SMH, like look at this rip higher in the semis.
I actually didn't realize that you got breakaway gaps.
Like full on gaps going. Like this is, and it's a fresh, a new yearly highs, just going full throttle ahead, and that's every space. Even I was skeptical a little bit about like the social media. Actually, let's go through some of the different sectors and look at some of the different things. Like for instance, social media stocks. ripping fresh highs here. I was just not thinking that was going to happen. And like it doesn't matter what Netflix specials you put on about the problems with social media. Like clearly this is still taking huge money flow on there. And it's just where the money is going. But let's actually go through some of these different sectors and see what's going on. Particularly in the doghouse remains the financials. Like the banks just have not moved.
And the regionals are even worse.
Yeah.
KRE.
Well, no. Look, the money center banks have been in a sideways range. At least the KRE, if you look at just the last 1 month,
the KRE, though, is worse because it got you excited. It almost looked like it wanted to go. It gave you hope, and then it dashed it. At least the money centers have been consistent that they stink.
There you go. Yeah. And so what's interesting is, the consumer discretionaries are definitely got some of the wind in their sails. You have the consumer staples bouncing a little bit, but it's interesting. Like when we get retail is back. Retail, interesting that the retail index, while it's been incredibly strong, there are some names obviously like Costco that have just been in such bull trend, and even like Target. Like you look at some of these charts and they've been just ripping, and the retailers continue to do well. It'll be interesting to see. Maybe they'll stay strong into the U.S. Thanksgiving holiday, but they certainly are catching some tailwind. Now, me and you had this big talk about what's happening in healthcare and biotech. Obviously, biotech's gapped higher. Obviously, Biogen was the big contributor to the biotech's gapping. Right, and it was a big move, and obviously
that was quite a move. 250 to 360.
Oh no, it's huge. It's huge. It was a big day. But what's interesting is the entire healthcare space was ripping. And so if you look here, the biotech index, even with Biogen's tailwind, did not make 52-week high, but the healthcare ETF did. And it's pretty broad, whether you take Lilly or you take, some of the moves in any of them, like Merck and all of them. They've all had these gaps higher, and they're working, right? Abbott Labs breaking out. The healthcare, there's money coming in here and it's working, and it's really interesting to see whether or not there's going to continue to be outperformance in this space. The industrials holding up along their highs. Interestingly, one of the places that's continued to dog it is aerospace defense. Obviously, Boeing is a big drag on that, but there is just nothing positive to say about any of the other ones. I'm curious, when there's going to be some potential turnaround in this space. They certainly are dogging it, almost like a financial stock. I don't know. Do you have any insights as to what's the drag there?
Well, if Biden had won clean, I would have said not only would those have continued to dog, they would actually be a great sale. Because if you read that Hillary Clinton recently wrote an article in Foreign Affairs that outlined what you have to kind of assume will be the Democratic policy for the military, and it was definitely going to be taking an axe to the budget. Now, having said that, given that it looks like we're going to have a Republican Senate and we're going to have a divided House, I don't know if that's still going to be on the table, but it's tough to get excited about the sector. Yeah. The reality is, Patrick, there's not enough money to go around. When you're thinking about what, these large deficits, is this the kind of environment where you'll see increased spending on defense? I don't think so.
Yeah. And so moving on here, look at the way the materials index is running. Just a fresh high. It's got full momentum behind it. Energy, though, continues to dog it. Obviously, oil has been a big drag. Oil itself as a commodity has simply not been able to get into bull trend like the vast
Patrick,
majority.
Don't mean to walk all over you there or step all over you, but I've been saying it. I'm going to stick to it. First week of December. That's when this sector's bottoming. That's when you buy it.
All right, love it. You know what? I'm not going to disagree with you. I've got way too much of this shit. Anyway, but what's interesting is here. This is the communication sector. Nice gap higher, rolling up. Will it? We see a fresh breakout here. A lot of these charts have really been like wound up for months, and they're all exploding higher. Often, these are the signs of the beginning of trend. And while, I've been inclined to being bearish, this is certainly hard to find anything bearish about these charts. It's I'm going to have to put away the bear cap and lay low for a while before wanting to short any of this shit. Interesting, the utils continue to edge higher. And what's interesting is home builders. The home builders had this consolidation for a month. They were dogging it through much of October, and a nice breakout. Are you still bullish to home builders here?
I am. I'm a little less excited about them. It seems to be that whereas before you used to make fun of me, and a lot of people would tell me I was an idiot for being a long home builder. Some people are telling me that they like it, and you know me, I get nervous when people start to agree with me. I like it better when you tell me I'm an idiot.
Yeah. You and Mike Green, right? And anyway, we go to the transportation index. What a bull run this has had. It's not the strongest sector coming out of the gate here, but it'll be interesting to see whether it recovers. But what's interesting here, another one that looks almost the same as the chart on the defense contractors. Obviously, Boeing overlaps, but this is the JETS index. But the airlines have continued to dog it. It'll be interesting to see whether the airlines have really established lows. We have not seen any major breakouts here, but this is quiet. Maybe the sneaky tortoise emerges here in the airline.
Tortoise.
Yeah,
I don't think so. Listen, Patrick, unless we get a vaccine, it's going to be tough for that industry to do well.
Yeah. Yeah, and another interesting thing, the real estate sector. This is the REITs ETF. It's been quiet. It looks like the financials. But you know what has been hot? The not so rare earths.
Not so rare. They really are, aren't they? It's because everyone and their dog is making electric vehicles.
Yeah, and so you have.
Good call. You've been bullish on that. Kudos to you, Patrick.
But it's interesting though. But the last 4 days in particular, is it the EV story? You think that's what's driving it in this last few days?
I'm assuming like the EV story's gotten a lot of hype recently. It hasn't been led by Tesla. It's been led by all the Chinese names. Pull up the NIO, NIO.
Wow, unbelievable.
And then, look at that thing. It was $22 a couple months ago.
Unbelievable.
It's now $42. LI is another one.
Yeah.
And then XPEV. EXPEV. PEV, Edward Victor. No, no, sorry. You got me doing it now. X-ray Paul Edward Victor.
We should coordinate these things.
Yeah, we should almost plan these things.
What a run! What is this, like an IPO?
No, well, I think it's a new listing. These are Chinese kind of electrical vehicle companies.
They're all running for sure, but nonetheless, they got these huge runs. But look at this chart. It looks like. There's a real legitimate turn here in this rare earths. Maybe this thing's going north of 50 in this push. We'll have to watch. Copper, a fresh breakout. Copper is just like the rare earths. That's the popular metal right now. And this type of a bull breakout, maybe this copper ETF is heading, even up to 30 if it's under the right conditions. It looks really bullish.
Patrick, I'm trying my best to own copper and not think about it. The story is so bullish. The electrification of the world is occurring. We're going to need a lot more copper. I try to just own it and close my eyes and forget about it.
Yeah.
Stop bringing it up.
Okay, no problem. So gold miners, look at that. Is that a breakout for you? It looks like a breakout to me.
I don't know. I don't practice the dark art of technical analysis, so I can't really talk about that. But I like the gold miners.
even if you just draw the amateur trend line, that's not so amateur. It's the breakout is here. So the question is, are we about to see the gold miners finally get some tailwind? That's certainly something to watch. But what I wanted to talk about here, and we're just going to use like the Canadian ETF for it, but this is the
pot stocks.
Pot stocks. This is the marijuana life sciences
marijuana.
ETF.
Not that us Canadians know anything about marijuana.
No, we don't. And so this is what a breakout in this post-election period. Obviously, the big theme is that they're going to move toward legalization, and it's really getting some tailwind. But what a move in the last few days, right?
So I do have some color to give you here.
I want to hear some color.
So one of the big moves today was Aurora Cannabis, right?
Yeah.
ACB. And if someone's listening, I got this from one of my broker pals. I'm not sure this is true, but supposedly a lot of people were expecting this firm to need money. And one of the popular trades in the cannabis sector has been to lean on stocks and try to force them to do a financing where you're short. It's been very popular, and you just have to look at the charts to realize that it's the trend has been down.
Yeah.
And it's worked. Well, supposedly everyone thought Aurora Cannabis was going to need some money. They were pushing their bet a little too big, and they got their face ripped off. This thing was it traded at $12 today on the US side?
From $4 to 12.
Yeah.
Unbelievable.
That's like a John Travolta, Nicolas Cage face ripper.
And even when you look at Canopy, this is on the Canadian side, but we can look at it as well on the US. But what a move, 20 to 30 on an impulse, just what a.
I think, Patrick, there's a lot of people that have tried too much on the short side of these things. I wouldn't be surprised at all if we get more face ripping. But this is over.
So I remember back in 2018, and I was so sure that this was going to turn out exactly like the .com bubble, and that 90% of the players were going to implode. There was going to be huge consolidation. We would see huge drops in the equity values, and then they would bottom, and there would be the buying opportunities many years forward, almost the same way like buying Amazon in 2003 or 2004. And it's now been 2 solid years since the peaks, right? And from top to bottom, even the biggest players have already wiped out top to bottom 83%, right? And so the purge has happened. They were left for dead, right? Like
Patrick,
and
given what's going on with the election, I'm not sure that's the greatest choice of words.
All right. Anyway, that's what I wanted to talk about, Kev.
Okay, well,
let me ask you. I'm going to ask you. Well, we're going to leave everyone. We used to do a top 3 segment. Now we're going to just do what are you watching? Leave our listeners with something. What is it that you're watching next week?
So that's what I was going to remind you of. So well done, Patrick. You remembered. I'm watching the US dollar. I think it's the most important chart.
Oh my God. You stole my freaking. Okay. Go on. All right. Go.
Well, it's the one chart. It's like it's the one ring to rule them all. It's the one chart to rule them all.
What a move!
And for all those U.S. dollar bulls that are telling me that that all this has got to cause the U.S. dollar to rally, and meanwhile we're pushing up against the lows.
Yeah,
and it'll be interesting to see if we push to new lows. Does that accelerate? So I didn't mean to steal your thunder. What are you watching next week?
Well, you know what? Listen, the dollar is definitely the thing to watch, right? And so when David was on the episode a couple of weeks ago, he particularly was even focused on that big support line on the U.S. dollar yen, saying that there was that big support along the 104, and look, it didn't hold. Right. And you know what? With this breakdown, that really solidifies. This is the first of the currencies, because the euro's not at a fresh multi-month high. The pound isn't, but the renminbi is, and the U.S. dollar yen is already looking like it wants to gun for that March low near 101. And so there's a bigger currency move. And you're looking at it, the Canadian dollar wants to punch that 52-week high. All right. The Aussie dollar is not far from wanting to punch a fresh 52-week high. Things are moving, and but the one thing, since you stole my currency move, we have to put a chart up on, because how could we not talk about it? But what a rip in Bitcoin. Now we're no coiners. I'm not gonna be thinking, but listen, we got to give these Bitcoiners credit. They were on this thing, and it is the best performing.
It's been terrific, no doubt about it.
What a run! Like when this started in October, I was identifying that breakout, but I was like, yeah, it's going to come to its previous highs. We'll see what happens. No, the thing hasn't looked back. Yeah. Like it's going, and it's like, anyway.
Just remember one last thing about the Bitcoin. I encourage everyone to go read the story about the trading sardines. That's all I'm going to say. Okay, so that's it, Patrick. We're watching the U.S. dollar next week. You're watching the Australian dollar, the Canadian dollar for breakouts. The Japanese yen, it was no such thing as a triple bottom, proved once again correct. That's what we're watching.
There you go. All right.
Patrick, time for This Week in Trading History. What do you got for us?
Well, I got actually two separate shorter history hits. And the first one's going to start with This Week in Trading History on November 5th of 1626. Peter Sagan, which was an official of the Dutch West India Company, reports the purchase of the island of Manhattan for 60 guilders from the Lenape Indians. Now,
whoa. That was a bad trade.
No, stop right there. Completely hypothetically, if 60 guilders was able to be compounded at 6%, it would be worth roughly 165 billion guilders today, which is about 75 billion US dollars, which is about half of the current value of Manhattan real estate. Now, I don't know if they invested it, but I'm just saying,
it's maybe not as bad as I thought.
On an inflation-adjusted basis, it may actually not be as bad. Anyway,
do you think those native people invested it? I think
anyway, so let's
in index fund. I think they put it in. Index fund.
Yeah, I think they did. So let's just a little bit back story here. So the colony of New Netherlands was established by the Dutch West India Company, not to be mixed up with the Dutch East India Company, which we covered before, which was the first corporation to ever be formed and traded on the first stock exchange. We can always revisit that story, but nonetheless, New Netherlands encompassed all the present-day New York City, parts of Long Island, Connecticut, and New Jersey. A successful Dutch settlement in the new colony. It grew up in the southern tip of Manhattan Island, that was christened as New Amsterdam. But it was in 1664 when New Amsterdam was passed to English control, and the English-Dutch settlers lived peacefully together. But it was surrendered to an English naval squadron under Colonel Richard Nichols. Following the capture, New Amsterdam's name was changed to New York in honor of the Duke of York, who organized the mission. And it was in 1673, there was a short interruption of English rule where Netherlands temporarily regained the settlement, but in 1674, New York was returned to the English, and in 1686, it became the first city in the colonies to receive a royal charter. And so it's that was the first quick little hit. And the second one, which was on this day in market history on November 6th of 1907, organized by J.P. Morgan himself, a boat arrives in New York with $7 million worth of gold from London to help bail out the U.S. financial system during the Panic of 1907. And I was just thinking to myself, Kev, wouldn't it have been amazing if Stephanie Kelton was around back in 1907 to explain to J.P. Morgan that they didn't need all that gold over there and they could have just...
you just can't resist. You just can't resist.
So anyway, the boat also brings word that a 10 million further of gold was behind it on the Lusitania, which was the same boat that would be sunk by Germans on May 7th of 1915. In the end, the plan worked, and the panic in the markets would subside. J.P. Morgan was monumental in saving the economy from the panic in 1907. He'd been working for weeks prior to November 6th to help avert the crisis, but by most notably locking bankers in his office until they came together with a plan to save the economy. It's amazing how history rhymes 100 years later, right? But one, just a couple quick hits and you can comment. This would be Morgan's last great effort to help restore the U.S. economy from the panic of 1907, and obviously the panic laid the groundwork for the Federal Reserve System that we have in place today. That's history. What's your little comment you wanted to say?
I'm just going to laugh and say that if Stephanie was around, she would tell you that it doesn't actually count, because the reality is that it was tied to gold, and therefore they weren't MMT. They weren't truly a sovereign nation and having a sovereign monetary system like the current system.
Okay.
It's not fiat based.
Thank you for sharing, Kevin.
Yeah. You're welcome, bud.
All right. It's time for WTF Clip of the Week. Now, Kev, we don't have a new one, right? So what's the story?
So we went and pulled an old one, and I thought it was pretty funny, actually. It was one of mine, and it was way back when, would you believe it? Jay Powell was getting accused of actually being too tight. Anyways, let's run the clip.
All right.
Unfortunately, recent political pressure on the Fed is having real-world economic consequences. A recent study found that markets react each time you are publicly pressured to intervene in the economy, with a quantifiable change in investors' expectations that the Fed's interest rate targets will drop. Chair Powell, can you tell the committee what actions you are taking at the Federal Reserve to not only insulate against political influence, but also to signal to investors that the Fed makes independent decisions based on sound economic analyses?
Thank you. So politics plays absolutely no role in our decisions.
Because I was inverted. Bullshit.
We use the best data, the best analysis we can muster. Mm-hmm. We're human, we'll make mistakes, but we won't make mistakes of character or integrity.
I smell bullshit.
I am familiar with that research, and I would just say I think it's very hard to look at, our incredibly complicated financial markets and economy where many, many things are driving results and pull out one or two tiny effects. There's other research that points to different results, but it's absolutely essential that everyone understands that we are doing our jobs as we always have without regard to politics. We serve all Americans. We do the best we can based on our analysis. We try to be as transparent as we can. We explain ourselves, put everything we do on the record. When people dissent, they put their dissent on the record.
Yep.
And that's as it should be.
Yep.
Everything that guy just says, bullshit. Thank you.
That's awesome, Kev.
It's a blast from the past. I enjoyed that. It was a little bit longer, but it was interesting to see Jay Powell in a little bit different light, eh, Patrick?
Absolutely. All right, let's go on. All right, time for No Stupid Questions. Lena, hop on. Hey, finally you get to back on the air here.
I've been waiting for this the whole time.
Oh, yeah, there you go.
So the first question here from one of the listeners is, hey guys and gal, I have a question about the best way to roll an in-the-money call spread. Say I'm looking for a $4 call expiring in January and short the $10 call expiring at the same time. The underlying is currently trading at around $10.50 and I'm still bullish. PEIX. Would it be better to close the spread and roll into the naked call, close the short call and sell a further out of the money call, let it ride, or take my profits and run? Thanks, guys. Love the show.
All right. Kev, can I take this?
You take this one.
No,
This is,
so now-
right up your alley.
It's up my alley, and because I've been in this situation many times, and one of the first considerations is the liquidity of the options and the spreads, and how much slippage you'd have in closing it out. But for me, one of the things I look at is whenever I open a debit spread, I'm buying exposure to a certain part of the upside. And so when I have the problem that the stock I picked is making too much money and it's blowing through the spread because I've been just too right and it just keeps going, I often don't worry about the initial spread. I let the spread play out because you reach the maximum profit of that debit spread at expiration. And so often, if I feel like I want to participate in further upside of the security, I just go on and open a second spread to complement the first one to buy me more upside for further. And so rather than dealing with the complexities of rolling up the $10 call or doing all these different, which are all acceptable ways of approaching it, at least I'm saying from what I would do, I typically would leave the original spread and just add a complementary new debit spread to keep it going if I want more further upside. Do you have any insights on that?
I don't have any insights, Patrick. You're the guru at this, and that was a terrific answer. And actually, I probably agree with you. Don't make your life more complicated. Make a new trade if you and just treat it as a new position.
Yeah, perfect. All right, Lena, second question.
Second question is, hi, Patrick and Kevin. Love your show. It is always insightful and fun. Love your guests. My questions, what do you think of shorting equal amount of SQQQ and TQQQ long-term balance monthly or quarterly? I am wondering if this is a variable strategy for making money. Also, how do we go about backtest these ideas?
So, isn't it funny that that Mike Green was talking about doing this?
It's really like we picked the questions before the interview. And we picked this one. I was like, oh, this is a great question. Let's go with this one. And then Mike actually addressed this, which was just ironic. And it just goes to show you how life is actually much more random than we think. Yeah. So let's just talk about this. Yes, over the long run, this is a strategy that many people employ in terms of shorting both sides and letting volatility work to their advantage. And I don't know if I need to explain it because Mike did such a good job, but the long and short of it is as it moves up and down and all around, you get chewed up in terms of if you're long these products.
Yeah.
So a lot of people will choose to be short the products. Now, one thing that Mike did not talk about is there are circumstances where you do lose. And what are those circumstances? A consistent day after day trending market actually loses. And so one of the interesting things is I actually did a study once about this in terms of pulling all the numbers, imagined, I don't know, whatever, a rebalance of every month, and then looked at my P&L. And over the long run, there's no doubt that this is a positive strategy and it makes money, but there are periods of intense pain. And all you have to do is think about this past 5 days. The past 5 days have been straight up in the market, and each day you're short. It's actually has not come back, so you're getting longer and longer and longer, and the leverage is actually working for you, not against you. And that's the important thing to understand is it only works for you when it moves up and down, up and down. A trending market actually doesn't work. So how do you go about testing this? What I would suggest is you could get onto Yahoo Finance or whatever, pull the actual data into a spreadsheet, and then just figure out when you want to rebalance and do it. And you'll see that there are times that this strategy does not work. So one of the things that I would encourage listeners that are interested in this is make sure that you understand the periods of pain, how big they're going to be. And then finally, one last thing, you have to account for the borrow, meaning that when you go look at the strategy, you could say, well, I'm going to go and do this strategy and I'm going to short these two and I'm going to look at the P&L. But don't forget, you're going to have a cost that in terms of borrowing those securities.
Yeah.
And some of them are cheap, but others are expensive. And that is an important part of the equation.
Now, Kev, I'm going to ask you, have you looked at some of these things like the ultra long and ultra short things on commodities, such as, let's say, silver, where they're actually using commodities that are in trading in contango, and how does that dynamically change everything? Like something like the SQQ doesn't really have, it discounts the interest rates and carry, but the commodities are a little bit of a different animal. I mean, did you see?
It is a little bit different, but it's still the same concept, Patrick, in that if it moves up and down versus trending, it's a completely different kind of ball of wax. Like it really, the path upon which the volatility occurs is very important on these double and triple ETFs. Yeah. So don't discount that. It's not like it's a foolproof strategy. There are times where you lose, and what I found is you lose when the thing trends in a consistent basis.
Yeah. All right.
Lena, get back on and tell people where they can send the questions.
We appreciate all the questions that we get. And if you have any other questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
Remember, there's no stupid questions, just stupid answers.
And we specialize in that.
Yeah. Okay, Patrick, time for skin in the game. You must have been looking forward to
this. I needed this so bad, buddy. I needed it so bad.
First of all,
Cuppy won one for me, but it's
yeah. Did I lose both sides? Did it even hit the upper end?
I don't know. What was the upper bound? I think it was like 34.20 or something.
Lena, do you remember
Yeah, it was 34.20.
Okay, so I got one.
You got the tap.
And how close did I come to the second one? Let's go look.
Like 30 points or something.
So let me just remind people, the bet last week was that I thought that the December S&P 500 future would touch both 31.95 and 34.20.
So 32.25 was the lows on the SPOOs. So you basically missed it by 30 points.
Oh, it was closer than I thought.
It was pretty close.
So my thinking was, I assumed you would take no. I just assumed. I was like, and I could be wrong. Yeah, no, I assumed you would take no.
Why?
Because I thought you weren't going to be that bullish. So I thought I had put it high enough that you wouldn't care. So I thought, because you're generally a bear. So I thought I'd put it high enough that you wouldn't care. So my goal was, when I was thinking about how it was going to play out, I was hoping that it would touch it either the night of the election or even the day before. And I was hoping it would dip down and then rally up. And it did dip down. It just didn't dip down enough. So I was close. But it's good to see you win one, Patrick.
Absolutely. So what was the bet? I think it was a pitcher, wasn't it? We stopped. We didn't do a case of beer.
So let me
go through the rules.
Let me rules. Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wager is as follows. A Duke and Duke, which is from Trading Places. It's a dollar, crisp U.S. dollar bill. A pint of beer, a burger bet, a pitcher, a case of beer, which is 2-4, a bottle of wine. We put a $100 limit, but Patrick really needs a minimum. And then finally, a steak dinner. So the winner of the bet is obligated to create a new bet for the following week. So that's you this week, Patrick. And all wagers settle in full. And this is the most important part. This is like swap settlements pre-Great Financial Crisis. There will be no netting of positions.
No netting. It's physical delivery contracts of the goods, and no netting. And
That's
so
right.
there's
important.
There's a lot, we have to start delivering this because, you know what, at least with the cases of beer, which we should get up there because it's easy to deliver a case of beer.
I don't know. I think
we
should wait for the COVID to be gone.
Oh, so then we take a picture of the fact that I have to get a pickup truck with like
Come on, buddy.
7
I'm
cases.
You're going to turn it around. I'm hopeful this is the start of a new role for you. Okay, So tell me what you got for me this week.
All right. So this week, I'm going to the TLT. Now, listen. I wanted to we could have used the move index or something, but I want to make a bet on bond volatility.
Okay.
And I wanted to leave the front month, so we're not looking at November and December settlement. I went out to the January option, which was the leap prior. And we obviously had our little volplosion of volatility in the post-election period. We saw it on the VIX, and we saw it on many of those big tech stocks, but it happened in bonds too. So we went from pre-election of it was trading up near 18.8% vol, and went down to about 14%. We're right at the bottom of this vol. And so
this is the implied volatility of the January series
of options. And this is based upon IB. We're going to look at this chart a week from now to settle. Okay. And I'm giving you the gift of a straight on over under off 14.4.
Oh, that's hard. Good call, buddy. This is a tough one. I must say, this is a tough one. So we're gonna use whatever IB says. So you're basically giving me up or down in terms of implied from here.
And the tie of 14.4 goes to the low. So in other words, if you take above, it's got to be 14.5. 14.4 close the tie goes to the low.
Well, obviously I can tell which way you're going.
What do you mean which way I'm going? I'm giving you a clean 50-50 shot here.
God, I want to hit the timeout button and let me think about this. So for those who don't know, we actually don't allow. I'm going higher, Patrick.
Good.
I'm going higher.
All right, let's do it. So let's go to the bets.
Okay, I'm actually feeling good about this.
Okay,
I'll up.
You're upping it, and I get to up it first. I'm going to pint of beer.
A burger.
Okay, I'll leave it at burger bet. I'm hungry.
Okay. Okay, I don't think we've had a burger bet yet, so that's a good one.
Right. And so burger bet, you're taking higher, I'm taking lower. You know what? I maybe if we had a long enough time horizon, I'd bet on your side. I'm happy with my position for 1 week. I think going into the November 13th, I'm happy with the burger bet here. Let's see what happens.
Okay, well, that's great.
All right. So I guess that makes it a show, right?
Listen, a couple of housekeeping notes. This week is usually Cuppy's time. Unfortunately, Cuppy couldn't be with us, but don't be worried. He'll be back next month for Cuppy's Corner. And then in the meantime, thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle on Twitter.
Give us a like or a subscribe. That would be awesome.
Well, can you like? I guess you can on Twitter. Anyway,
yeah, it's called
Lena's
thumbs
in charge of all that. You're actually Lena's the one who likes those things. We don't actually pay attention to the Market Huddle. No, I'm just kidding. We love it, Lena. You can listen to the Market Huddle on all your networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And please, if you could, rate us on iTunes. We really appreciate all those listeners that have done so in the past, and we just would really, really mean a lot to us if you guys could do that. Anyways, Patrick, where can they find you?
You can find me at Patrick Ceresna on Twitter, and you can follow me at bigpicturetrading.com. How about you, Kev?
I'm at Kevin Muir on Twitter, and you can go check out my newsletter at Kevin Muir. Sorry. Let's try that again. You can go check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
Now, you didn't say Substack, though, did you?
It's
macrotourist.substack.
I got the Substack thing. It's actually, I got a homepage now.
Yeah, get with the program. It's been like that for a couple of weeks now.
Amateur hour.
Well, amateur hour, I flubbed a couple of things there.
I'm leaving it in.
Yeah, I know. I knew that. That's fine. I'm always the one that always says you should leave all them in. I'm the no edit guy. Okay, so let's do this beer.
Yeah. Oh my God, I liked it.
Surprise!
I liked it too.
Surprise.
I thought that the guy on the front cover of it with his crazy long fingernails kind of made me a little bit worried.
That's light. That's light. That isn't fingertails. That's lights coming out of his fingernails.
I don't know. It's weird.
Oh my God.
It's weird.
But if you didn't see if you didn't see the artwork on the can,
I know.
would that make
you know what? It was, and the fact that I didn't taste any coconuts. I don't know.
Like you were looking for it. All right, so go rate it. What's your rating?
I liked it. I'm going to give it a 7.9.
Oh, it's pretty high.
Yeah.
For those who don't know, my best friend sent me a whole bunch of them. So we are going to have Swedish beers for like 2 months.
What did they can mail that shit?
Yeah, he mailed it. Do you want to know
awesome.
the funniest thing about it? He mailed it to me and he says, "Oh, you know what? Have you got it?" And I said, "No, I haven't got it." And I said, I will go check with my son, see if he's picked it up, put it somewhere. And I'm like, "No, I haven't got it." And we go look. He goes, "Someone signed for it." And I'm like, "What do you mean?" And I go, "Where did you send it?" He sent it to a house that I haven't been to, lived in for 20 years.
Oh my gosh.
I had to like track down the real estate agent that had recently sold it, who then tracked down the buying agent, who then got in touch with the contractor that was working there. And it's very nice. And the nice part about this story, and it just goes to show you there's always a positive to any sort of error. I got to go and look around the house that I haven't been to in 20 years that our first daughter was born in. So it was actually a lot of fun.
Wow.
Yeah.
There you go.
Yeah. So it was a lot
And you
of fun.
gave it a 7.9.
Yeah.
Wow.
So Patrick,
All right.
what do you give it?
You know what? The flavor was good. It's drinkable. It's smooth. I would definitely drink a few more of these. The only problem I have with this is it's not a tall boy. Like these little
I know.
stubbies. Like
They are
this is
little small.
this is amateur hour. Like how are you supposed to get a good buzz on these little small?
I'm going
tiny
to tell him he
beers?
should send us more.
You know what? If this was a tall boy, I'd give it an 8. But because it's this little stubby little thing, I'm going down to like a 7.4. That's
we go.
that's just
The
because
format.
they robbed me. They
format.
robbed me of a tall boy.
That's it. And I unfortunately didn't get it to Lena, so poor Lena doesn't. She's been. Have you been drinking anything, Lena?
Actually, you know what? This is a good week for me to not drink because a couple of days ago I had a girlfriend over, and we had a good old girls' night, I guess you can call it, with some wine, a Magnum bottle of wine that I hadn't been drinking in a very long time. So the rest is history there. So I'm trying to nurse my liver back to its 100% health.
You could try the liver transplant like I got a couple weeks ago.
My liver's
it
not
heals
that bad
quick.
yet, but maybe by next year.
There you go.
Okay,
All right.
so what did you guys do this week? Anything exciting?
No, I was hungover. I told you.
Oh yeah, well Lena is saying. So Patrick, did you do anything? Patrick, you were out of quarantine.
Oh yeah.
Yeah. I did go streaking, but I didn't think that was worth mentioning.
Well, I think everybody's just been preoccupied paying attention to the election, right?
Oh, yeah.
I know.
But,
It was.
It's
We'll
over.
see what
It's over.
happens.
Well, it's not over, but you know what? It's over from the anxiety. Now there's certainty of that fact that it's a gong show. It's there was this anxiety that it might have been a gong show, but it might have been fine. But now we know it is. So
Patrick, you got to be careful. Don't be saying stuff.
Hey, I am not picking sides. I'm noting that the outcome was the worst possible outcome, which is there was no clarity.
That's right.
Right? Like it's a gong show. Like that
Well,
is not
I
that's
don't
not
know.
me picking sides.
It's
I'm
a
not picking
process.
sides.
It's a process. I don't think it was a gong show actually. Given how much all the Doomsday Fintwit Bears got it, everyone excited about it, I think it was actually quite reasonable.
Okay.
And like the reality is, what do we expect? Like, of course,
it could have been worse.
Yeah. Listen, I actually have been very pleased with how it went in terms of it not devolving. Let's see if this weekend holds up. I'm hoping it does. I actually think that I've been saying this for a while, and I said it on that podcast that you cheat on me with. But I've been saying for a while that it's not going to be as bad as everyone expects because there's all sorts of expectations for this to devolve into riots and all this stuff.
I'm with you in one thing. Is that rarely does a stock market ever crash because of something it sees coming from a mile away.
Right.
Almost everything that ever crashes a market is a blindside. Something that wasn't priced in, something that wasn't accounted for, something people were disregarding. Like this election was so well advertised for half a year of all these different scenarios, how could participants not have accounted for every possibility and kind of figured a trade plan of how they're going to manage it? It's like you're not going to have a liquidity event in that kind of a condition. Enough about that. Lena, well, how about you?
How about me? What? Sorry, about the election?
What?
You got any good shows for us?
Oh,
yeah. Like
actually, I've been kind of trying to scour different subscriptions that I've got, trying to see if there's any shows or movies I haven't seen yet. And on HBO, I watched this 3-part documentary called Paradise Lost. I don't know if you guys heard of it. It's from like the 90s, actually. No. And it's in a span of, I think, 18 years they filmed this. And it's about 3, like 16, 17, 18-year-old boys in 94, I think. They got convicted of killing 3 8-year-old boys. This is in Arkansas, and in Arkansas, West Memphis, I think, and it's like a whole process. I blew through it in like 2 days. It's a bit of a sad story, and about what kind of injustice was served in that sort of situation.
No kidding. I'm just going to go get into a warm bath and slip my wrist after listening to that. Jesus Christ.
I like true crime documentaries, and, it's interesting, but also if you think about it, if you were, that person on the receiving end of that, it's pretty scary.
Yeah. What is with women and the true crime stuff? They love it.
I don't know what it is, actually.
It's like you guys love it.
I think we just...
Like my wife listens to this thing called My Favorite Murder. It's these 2 women.
You've mentioned it before.
Yeah.
This thing is the biggest phenomenon. Like these 2 women, they just basically talk about murders. Now they're funny. Like I've listened to it. They're legitimately funny. And I think one of them was a writer on Ellen and stuff. So it's not like they're not talented, but the concept is like, why?
So morbid?
I say to my wife, like, why do you want to hear about these things? She's got me now. I can't pull over into like a rest stop without worrying about stuff now. Like she's. I used to no problem, go pull into a rest stop, no problem. It's 2 a.m, no big deal. I got to take a pee, and now all of a sudden it's I can't think about anything but all the murders that have happened there.
I know what you mean. But I don't know what it is. I don't know. I don't know what it is, but I've always been interested in listening to or watching murder documentaries.
Fear of God in your soul.
Yeah, I guess. I don't know. I started getting into those things when I was living alone in Calgary by myself. I was in my apartment on the 2nd floor apartment, old apartment building, and I don't know why I started because
it makes complete sense. Yeah. All alone. Foreign city.
Yeah, exactly.
You know what I'll do?
Young girl.
I'll get into true crime.
Yeah, exactly.
That makes a lot of sense.
Made me never want to leave the apartment, but that's
there you go.
God. Okay. Well, anyways, I think Patrick's got a heart out, so let's call it a night. Listen, a big thanks to Mike Green, and thanks to all you guys for tuning in this long. And have a great week, and we'll see you next weekend.
That's right.
All right. Take care, everyone. Have a good weekend.
Bye-bye.